Good morning and welcome to Fix It Finance, the wonderful world of Fix It Finance. Today is an exciting day. We are learning about mortgages and credit worthiness. If you're new here, we go live on Saturdays, and we have a few videos in our live section on the YouTube page if you want to check it out. Last week we talked about taxes. The week before we talked about a few things, but the one that stood out the most was, talking to your parents and loved ones about their estate plans in general. And then the week before that, we chatted about what did we talk about? I don't remember, but it was pretty interesting. Okay, so welcome. If you're new here, how we do this is I kind of chat a little bit about different topics. Today we're talking about mortgages and credit worthiness. And if you have questions while we go ahead, you can drop them in the comments and we'll answer the questions as we go. Okay, let's get right into it. Um Mortgages, credit worthiness. So let's do a little bit of backstory. Like why mortgages, why credit worthiness? Like what's the, what's oh welcome Oge. We're happy to have you. We're happy to have you. Thank you so much. Okay. So a little bit of backstory. Today we're talking about mortgages and um credit worthiness. So, you know, why do we want to know about this topic? Why should we learn about this? Why do you care, for lack of a better word? I say that a lot, by the way, so I apologize in advance. The first things first is the system we live in North America is a system that's based on credits, it's based on borrowing and lending, for different reasons and different purposes. Back in the day, Farmer John, for example, has a farm, you know, he can till the ground with his hands. However, John Deere makes a tractor down the road. And if he buys that tractor, he can produce 5 times his current output that he does by hand. But unfortunately, he cannot afford the tractor. So he goes to the bank, borrows money to buy the tractor, increases his productivity. And then the bank, of course, once his productivity increases to 5x, he pays the bank back their money and he keeps the excess. That's just the basics of a system that's based on credits. You use credits to leverage and to increase your productivity overall. So like I said, our system here in North America is based on lending. It's based on credit. It's an economy that's built on credit. So we have periods of like great lending, and then we also have periods of like, I like to call it payback, or they call it credit crunch in the market, but it's basically just payback period in my opinion. Okay. Um so a few things to understand first and foremost. In a system like ours that's based on credits, you understand, we have, the person of the Bank of Canada. So they set, monetary policy, they set different things in terms of who does what for why. They overall they look after the banks, they set basically anything the government does. They're basically the Bank of Canada. They do, I don't want to go into all that detail just because that's not the purpose of why we're here. But basically, you have the Bank of Canada and then you have the commercial banks, right? So that's your RBCs, BMOs, CIBCs, and whatnot. The deposits they are required to have, they keep with the Bank of Canada, right? So the reason I'm going into all this is because it's going to be a flow down, a bit of a flow down system. So you have Bank of Canada and then you have your commercial banks. Now, your commercial banks, their job is to create money in the economy. That's their work. That's the only job they have. A bank is never there to necessarily do you a favor. Their job is to make, their first and only job is to make money. So always remember that whenever you think a bank is giving you an offer or something, their first purpose is to make money. And there's nothing wrong with that. They do their job and they do it well. You understand? Yours is to protect your financial house and to protect your cash flow and to build wealth for yourself. So you to make sure you do your own job well. Okay. So um the commercial banks, their job is to receive deposits from people like us. So for example, Farmer John being our example, Farmer John sells his crops, takes the money, deposits it in the bank. So what the banks then do is, of course, they lend out that money to people that need it, so the difference in interest, so they will pay Farmer John a certain amount or a certain portion. As you all know, if you all have, most of you that have bank accounts, it's like chicken change, excuse me. They might pay you 0.05%, and they lend it out to the next person, say in a credit card, in a line of credit, in a mortgage at, 10. 12, 20%, almost in some cases, credit cards go up to like 29.99%, So that's how they make money. It's that differential in interest. Okay. So they lend money to borrowers and they lend money to people also like you and myself based on credit worthiness. Okay. What does that look like? What is credit worthiness? So credit worthiness is basically it's a measure of how risky you are as a borrower. So the bank is going to take money from people, and then they're going to lend it out to other people. In order to lend it out to those people, they have to assess how risky it is. Like, what's the risk if we give this money to this person, right? Is this person going to pay back this money? Okay. And there are a few things they look at when they look at your credit worthiness. One is your credit report and your credit score. They look at your income, they look at your assets, and of course, they look at your debts and your liabilities. Okay. So if we're looking at credit worthiness, what does that mean to you? What are the things you want to look out for as a person? What are the things you want to make sure you're addressing and make sure you are paying attention to as a person? If you know you're going to have to borrow one day, you might say, "Oh, I don't use credit cards, I don't use line of credit, I don't use this, I don't use that." That's fine, but you will need a mortgage one day. You might start a business tomorrow. You want to expand the business, and you're going to need credit, for example, to be able to leverage that to really multiply the business. Okay. What are they looking for? So when it comes to your credits and your credit report and your credit score, it's basically they're looking at different factors. You understand? Different things. They're looking at data on things like your loans. How many loans do you have? What are the balances on those loans? What are the credit limits? How often do you pay it off on time? Do you pay it off as promised? Do you have missed payments? Missed payments is a big deal when it comes to your credit worthiness. So if you have debt, make sure you don't miss your payments, because it's a no. It's a big red flag. Okay. Just from a credit worthiness perspective. Do you have delinquencies? Accounts that you're not even bothering to pay off or pay on at all? Do you have anything in collections? Do you have any bankruptcies? Those are the kind of things they're looking for in your credit report. The information, as a lot of you know, is sent from the different lenders. So you open an account with Rogers for your cell phone. Rogers, every month they send that data to the credit bureaus. There are two main ones in Canada, Equifax and TransUnion. Okay. What else? Those are some of the factors that they look at when it comes to your credit report and your credit score. So they look at sorry, one second. I just want to open up my notes to make sure I'm giving you everything. Okay. So they look at some of the factors affecting your credit score, including but not limited to, like I mentioned earlier, your payment history, your credit utilization ratio, the length of your credit history, how long you've actually had a history. If you've only started using credit in the last 6 months, that's not necessarily long enough for them. Your payment history, like I mentioned, the types of accounts you have. Do you have credit card type of accounts? One of those ones that are, do you have revolving accounts? Do you have accounts that, there's a steady amount every month? The amount of credit inquiries that happen on your account. So, for example, are you going around shopping for credit anywhere and everywhere? You get, in the sense of, they don't want to, are you perpetually looking for credit all the time, so you're getting all these hits on your credit report and your credit score. Okay. Usually when it comes to mortgages, you want to make sure you've fixed your credit or fixed your um like done an assessment of your credit report for yourself, so you know what they're going to find. Don't let them be the ones to tell you what they found. You should know going into your mortgage application, so you have an explanation for why XYZ happened. You understand? For example, let's say you had an account that got sent to collections. You need to know why that happened and be able to tell them, for lack of a better word, the story as to what happened. If you had missed payments and there's a reasonable explanation, why is that? So you need to be able to answer some of those questions. So don't make sure you do your own assessment of your credits before going into that application process. Okay. So when it comes to your income, one of the things they're looking at, they're trying to assess your ability to pay back. Of course, if you're going to get a mortgage, and we're going to be going into details on mortgages later, it's just I'm trying to give you the information on how to assess your own credit worthiness. So you go into your mortgage negotiations, or when you're going to buy your house, you go in prepared instead of guessing what's happening and trying to understand what's happening. Okay. For your income, they're going to use it to assess your ability to pay back. So for example, you make 50,000 a year, you want to buy $1 million house, you probably can't keep up with those payments. Okay, so they're going to use your income to assess your ability to pay back, right? They're going to assess things like your debt to income ratio, and they're going to assess things like your gross debt service ratio. So your debt to income ratio is basically looking the amount of debt your income is currently servicing. What does that look like when you now add on this mortgage? So if your income is already going towards a lot of debt, like servicing a lot of debt, that means you necessarily can't afford this mortgage. Okay, so they're going to look at that. We're going to go into an example actually calculating a DTI ratio as well as a GDS ratio. So just let me get through the notes and then we will go through that example so you understand exactly what they're looking for, not just what they are looking for. You need to understand how that works for you, because one of the major things a lot of people don't understand is usually for mortgages, you get qualified on your pre-tax income. And unless you live in a different country than I do, we are all going to pay tax in Canada. So you get assessed on your pre-tax income. So you need to know these numbers for yourself as to what you can actually afford. I'll give you an example. When we wanted to buy a house, for example, when we went for our pre-qualification, they qualified us for ×2 what we had said we were going to buy. Okay, we had done our calculation and we know, okay, we're not going above this amount, because at this amount is when our the amount of our income that will be going towards housing costs is going to exceed a certain percentage. So we didn't want our housing costs to exceed 25% of our income. Okay. And that's the number we chose for ourselves. That's where we're comfortable, because we want to build wealth and do other things with our money. But when they pre-qualified us, we literally qualified for ×2 of that, because you could put potentially more. There's some people that have 40% of their take-home pay going towards debt repayment and going towards their mortgage. Okay. So we'll go into all that in an example. Just give me a few minutes and let's finish these notes and then we'll go from there. Okay, so for your debt to income ratio, they're usually looking at a ratio of 42% or lower. Some people say 43, some say 42. In my opinion, the difference between 42 and 43, if you're already hitting 42 and 43, that's where the issue is. Let's work on that. Okay. Your GDS ratio, they're looking at about 39% or lower. They might allow you to go higher, for example, if you don't have debt and some of these other things. But the question is, should you go higher? Okay, which is what we'll talk about as we go through today's topic, which is what discussing credit worthiness for those of you that have just joined us, and mortgages today. Okay. So we talked about your credit report and your credit score, which is what they're looking. So that's the first thing they're looking for. We've talked about income, and then we're going to go through an example of calculating your ratio, so you know what your information going into your mortgage negotiations. Okay. They're also going to look at your assets, the value of the property you own. Keyword, of course, the properties themselves must have value. So cars, maybe stock, some of these other things, right? A house. So they must have value. So they look at that, because you have to know your own financial picture holistically before you go get a mortgage, because a lot of people don't necessarily know this. They run, get a mortgage, and then once they're in, they find themselves cash strapped, very tight. Things are very, very tight the moment they start paying that mortgage. So if you've not yet done that, or even if you've already done that, this session is going to teach you how to actually look at your finances holistically, so you understand why you're feeling that pinch. You understand? Okay. In looking at your assets, of course, they're wanting to know that, okay, if push comes to shove, for example, in the case of a house, the asset that's backing up that mortgage is the house itself. So what comes to worst, even if you lose your job or anything, you can sell the house, pay back the loan, and move on with your life. Okay. So those are some of the things they look at to assess credit worthiness. Of course, they will also look at your debts and your liabilities. So your debts in the sense of, okay, like what are some of the things you've taken on? For example, one of the advice you would always get out there in the streets is that before you go buy a house, don't go and buy a car. You understand? Because now you've just added a major amount. For example, let's say you go out and get a $50,000 car. That amount is going to get assessed when you're going to qualify for this mortgage. Okay. So again, we talked about a little bit, but I'll just recap for those that just joined us in terms of like how to improve your credit score and whatnot. Make sure you know your credit report and your credit score before you go and talk to the bank self. Like, know it for yourself. Most banks give you access to your credit score for free. You can check websites like Borrowwell to get your own credit score and your credit report and see what's actually happening there. Don't wait until they tell you. You should know what's happening before you go discuss, and have again an explanation or your reasoning as to why things happen the way they happen. For example, let's say you missed a couple of payments on your student loan. You can explain to them what happened. Oh, say you were out of a job, you forgot to call them, blah 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 blah. You understand? And just have that in the back of your hand when you're going into those discussions. So to improve your credit score, different advices out there. The number one thing I would say is don't miss a payment. Whatever you do, don't miss a payment. It's always better. If you know you're going to miss a payment, call them. Don't wait for them to call you. You understand? Call them and say, okay, I know I'm supposed to pay you 1,000 on the 15th. Today is the 9th. I will not have this money on the 15th. What can we do? Make a payment arrangement with them. You understand? It's always better to call them. Don't wait for them to call you. You understand? Because don't miss a payment. Whatever you do, do not miss a payment, because that's a major red flag, especially when it comes to a mortgage, because the mortgage provider is depending on the fact that you're going to make your payments on the first of each month or whatever date they pick for you. So you have to make sure you don't have any missed payments on your credit report, and if you do, you want to ask those questions, as you want to have those explanations as to why. Okay. um Limit how much you have in payments. This one is a bit of a no-brainer. So if you know you're going to go for a mortgage, you probably should not have like 25 things you're making payments on. So I say this all the time on all the social media platforms. In any session you hear me, I always talk about protecting your cash flow. You understand? Just because they offer a payment on it does not mean you should take it. Always, always, always protect your cash flow. You understand? You're better off waiting for, again, in certain situations and depending on the situation, you're better off waiting, save the money and buy it one time, as opposed to, you know, taking your cash flow hostage, for lack of a better word, because again, that's exactly what's happening. You sign up for something, you're going to make a payment on it for the next 5, 7, 8, 10 years. You've basically committed that part of your cash flow to this person for the next however period you've determined. Okay, so you always want to protect your cash flow. um you also want to keep your credit utilization on the low. A lot of you know this, under 30% for sure. So for example, let's say you have a $10,000 credit card, you never want to spend more than say 3,000 on it before you pay it back. um and I've said this a few times, I'll say it again: keep track of your credit score and the activities on your credit report. You should know what's happening on your credit report. Use free services like your bank or borrow well or stuff like that. Make sure you know what's happening. Okay. um and this one again seems like a no-brainer if you can't afford it, because if you have to put it on a payment, as much as possible, maybe don't buy it. Just a suggestion. Just because you can afford the payments doesn't necessarily mean you can afford it. I always encourage people to look at your finances holistically. Don't just look at what's happening in that moment. Look at it holistically, because you might make a decision today that will severely limit the kind of options you have tomorrow. Okay. um what else? Okay, I think that's I'll leave that in terms of credit worthiness. I think I've mentioned more than enough. If you have any questions on what I've said so far, please put it in the comments, and we would take the questions from there. Okay, so now let's move into mortgages. This is like mortgages 101. So if you're an experienced mortgage expert, you probably be like, oh wow, what's going on here? I know all this. And if you don't know much, this is the class for you. And even if you know a little bit, there's always something to learn. Okay, so mortgages. Here in Canada, there are different types of mortgages, as we all know. So, looking from different perspectives. So, the first one is there are three types of mortgages: there's insured mortgages, insurable mortgages, and uninsured mortgages. So, what does insurance mean in this particular context? It's basically insurance to protect the lender. Okay, so for example, CIBC or BMO or RBC or whoever, they want to loan out this mortgage to XYZ person. They know there's a risk that this person may default, so they get insurance on that mortgage. Okay. So what the first thing is, the first type of insurance is insured mortgages. So that's exactly if you put less than 20%, for example, of a down payment, you're required to pay mortgage insurance that protects the lender. In some, I believe in the US, they call it PMI. Here in Canada, it's covered by I believe it's three different houses, but we won't go into all that because I don't think that's important for today. What you need to understand is what type of mortgage is it. Okay. An insured mortgage, for example, is a mortgage whereby you have to get mortgage insurance. Basically, it's pretty straightforward. Usually has the lowest type of interest. Usually has the lowest type of, no, not type. Usually has lowest interest rate applied to it. And it always applies to mortgages whereby the down payment is less than 20%. Okay. And of course, it must be owner occupied property. So if you're going to pay less than 20%, you can't do that on a rental property for say. It has to be something that you are currently residing in. Okay. The next one is insurable mortgages. So this is where your down payment is 20% or more. Now, usually the bank would pay for that insurance, right? There's a table. I just want to put it in here because I think it's way too much information. But there's basically mortgage rates and whatnot. If you're putting 20% down, so now the bank takes care of the insurance on their end. Okay. Um it's usually higher interest rate again due to the higher risk. Oh, yes, you put down 20%, but the bank also has a risk. Okay. The lender pays the insurance, like I said. And then, of course, you have your uninsurable mortgages. So, for example, if you're going to get a loan of, say, over $1 million for a property, if your amortization is going to be more than 25 years, so if you're going to get a 30-year mortgage, that mortgage is not going to be insurable. Okay. If you're doing like a rental property, for example, um, well, non-owner occupied single unit rentals. Okay. So that those are the three types to understand. So most people will fall into the first two that I talked about. So that's your insured and then your insurable type of mortgage. Okay. The next thing is you want to understand is you have your open versus closed mortgages. An open mortgage basically means you can pay off the amount at any point during the term, right? So let's say it's a 5-year term, 10-year term, 20-year term. Sorry, not 20 years. I think the highest I've seen is 18. Okay, 18-year term, 15-year term. You can repay the full amount at any time during the term. And it's usually higher interest rate, of course, because the interest they will make on that if you decide to pay it off may not necessarily be what they've budgeted. Okay. Um, a closed mortgage, on the other hand, is something so you can only repay a limited amount. So for example, they might say something like for this particular mortgage, if it's a closed mortgage, you can only pay back say 10% of the principal per year, and you can make one lump sum 10% payments per year, or you can only pay back on a monthly basis no more than 20% of the principal. So that's a closed type of mortgage. You also, another way to look at mortgages, you have fixed versus variable mortgages. So a fixed mortgage is basically the interest rate is fixed. It's going to be fixed for the life of the term of the mortgage. So if it's a 5-year mortgage, the interest rate is going to be fixed for those 5 years. If it's a variable rate mortgage, of course, the rate is not fixed, it is variable. And that means that the payments can change up and down depending on, the lender's prime rate, which a lot of people saw during COVID, right? So when interest rates were down, some folks did variable mortgages. To an extent, some folks were pushing variable mortgages. And of course, when things started to go left, as interest rates increased, those payments also went up. So if you fell into that category, I feel I'm with you. Okay. Um. So I mentioned we were going to talk about DTI and GDS ratios. So GTI is basically your debt to income ratio. These are important financial factors you should know for yourself. Even if you're not going to get a mortgage, you should know this just because you want to know this. Okay. And then, of course, your GDS ratio. So I will open up, let me share my screen so we can walk through an example. Give me 2 seconds. Alrighty. Okay. So, well, let's start with which one do I want to start with? Okay, let's start with GDS. Oh, I see we have some questions. Okay. I'm gonna finish this first and then we'll take all the questions. Just because I have everything open. Okay. All right. So what is your GDS ratio? I mentioned it earlier. I also mentioned DTI earlier. GDS is basically your gross debt service ratio. So it helps lenders assess if you can actually afford the mortgage you're applying for. Okay. And this is where the income side of credit worthiness comes in, right? And then your DTI ratio is, they use it to assess how risky you are as a lender. Risk in the sense of, okay, you're servicing all these debts everywhere. How are we going to make sure that, this person will also be able to service our debts, the debts we're about to sign them up for? Okay. So let us begin. We're using John and Jane because, well, it's just easier to remember. So John and Jane, they have a combined household income of $180,000 pre-tax. So someone that's making 180,000, chances are they're bringing roughly is 9,680 something. So I just rounded it up to 10,000. So let's just say they're bringing home rather after tax, $120,000. Okay. And they live in, say, Alberta because the tax rate is lower there, and yeah. Okay. Just keep it simple. They're making 180,000 pre-tax, 120,000 after tax. So per month, they are making 15,000 pre-tax, 10,000 after tax. Now, calculating their oh no, before we go into it, let me give you a few more factors of this person's particular household. So their total debt right now is $42,000. Car, student loan, credit card, add anything else you can think of, line of credits, anything else you can think of, add it there. So let's just say their total debt right now is $42,000, which is pretty standard. Their monthly expense is roughly $4,500 a month. So this is their housing expense. So their mortgage, so the mortgage we're going to get for them, right? Let's just say right now it's a $500,000 house. They are putting 5% down. The average mortgage on a house like that in today's interest rate environment is about $3,500. It's actually 3,400 and something, but we're going to round it up and say $3,500. Okay. And then the additional 1,000 is to cover their property tax, utilities, condo fees, if they have any. And for the GDS ratio, it's usually 50% of condo fees. So in this case, they actually don't have any condo fees. It's a standalone house, just as an example. Okay. So I mentioned earlier the GDS ratio that the bank is usually looking for you to have is roughly 39%. Okay. And then the DTI ratio is around 42%. Some places say 43. In my opinion, 42 or 43 are pretty much the same thing. So we're working with 42 to keep it simple. So in this particular equation, let's calculate their debt to income ratio and their GDS ratio. Okay. Why is it not that changed? Oh, there we go. Okay, just keep it, make it easy for everyone to see. Okay. As of right now, this is what their ratios are going to be. Okay. Your DTI is basically your total debts, which is the 42,000, divided by your total income. So right now, their DTI is sitting at 23.3%, right? And right now we're allowed 42%. So they are sitting really, really good based on this application. Okay. Their GDS ratio, which is their gross debt service ratio, is basically their their household expenses divided by their monthly income. We're at 30%, and as I mentioned earlier, 39% allowed, right? So they're sitting real pretty. But if you remember, I mentioned they use your pre-tax income to calculate. So this is where a lot of people run into issues in the sense of the bank will qualify you based on your pre-tax income, right? And the reason for this is not because they're trying to be mean or anything. You can't determine a person's tax rate, because of course, if you file your taxes every year, it changes. There are different aspects. So they use your gross income, not your net income. Okay. You as a person have to make sure you use your own net income and calculate for yourself. Because what happens is this person goes in and thinks, oh, I qualify for this mortgage. It's so easy. Wow. Hallelujah. Thank you, Jesus. We have a house. And then they get in and they start making the monthly payments and they realize things are very, very, very tight. And the reason is because of this. So let's calculate their adjusted. Again, the bank is not going to do this for you. This is what you have to do for yourself. Okay. Their adjusted DTI and GDS is this. So now, like I mentioned, their debt is not that bad, right? Especially given their household income. So the 42,000 over 120,000 puts them at 35%. On their gross income, they're at 23, right? Puts them at 35% of 42. And that's okay because this 42,000, they don't have to pay it at once. It's on a monthly basis, right? Now look at their GDS ratio once we factor in their take-home pay. Their take-home pay is roughly 10,000. So that mortgage and the other household expenses is 45% of their take-home pay, right? 45% of their take-home pay. Keep in mind, we've not added the other amounts they're using to service their other debts. If you notice up here, that amount is $1,500 right here, right? This is what they are paying towards this 42,000. So let's say the car payment is 900, the student loan is 300, the credit card they're paying $100 a month. You understand? So everything adds up to $1,500 again, which is pretty standard. So in this situation, if you add up what they are paying for their mortgage and what they're using to service their debts, that is roughly $6,000. So before we say Jack Robinson, this family has $6,000 going out the door in payments. You understand? Out of 10,000. So you might be in this kind of situation, a lot of people will find themselves under pressure and wonder why but the bank and everything made sure we were good. So this is what I'm saying, in the sense of, you have to make sure you do those numbers for yourself so that you know what you can actually afford, not just because when you go to the bank to pre-qualify, this family will qualify easily. Just look again. Okay, we'll go into an article, but there's an article that I was reading yesterday, and basically the bank of they're trying to limit how much people can buy, basically. So basically saying they can't buy more than 4.5 times their annual income. In this case, these people's annual income is 180,000, right? So 180,000 times 4.5, 180,000 times 4.5 is 810,000, right? I wanted to show you my calculator so you could see it. 810,000. That's how much this family can actually afford. Okay. They've bought a $500,000 house, which is pretty reasonable. Okay. So basically, if you're in that situation and you're wondering why you're under pressure, for example, just using this family as example, the reason why is this calculation that we did. Okay. The calculation where we talked about, let me switch it. Where we talked about their adjusted GDI. So they have more than 50% of their income, right? Again, when you factor in what they are paying, this is all their housing costs. So mortgage, property tax, utilities, and then you factor in what they are using to pay off debt, because the debt payments have to happen, the car payments, the student loans, the credit cards, the line of credits, blah, blah, blah. So this family is currently spending roughly 60% of their income on debt servicing. There's only 40% left for things like, children will go to soccer, they will buy groceries, they will travel, they would, try and save for retirement from that money. They would do life in general. So this family will be under unnecessary pressure and be wondering why. So this is just a different way for you to look at it. So just because the bank qualifies you for a $900,000 house does not mean you should buy one. You should know your numbers and you should know your finances holistically. Okay. Like I mentioned, this is just one aspect to look at. We talked about other aspects at the beginning of the video. Okay. So I will leave that up for anybody, for the math people in our midst who want to look at it. Okay. The other thing I wanted to talk about is I have moved everything up and down. Oh, there we go. So how do you improve your DTI, for example, your debt to income ratio? Again, if you know you're going to buy a house or you're wanting to buy a house, these are some things you can do ahead of time to get yourself ready so you're not caught off guard. Because buying a house, once you can buy a house, and the thing is, it's a transaction that is not necessarily, it's complicated, but it's not that complicated. You understand? It's just, if you don't look at it holistically, you might be wondering why you're under unnecessary pressure. Okay. So you want to focus on reducing existing debt. So for example, if this family had taken time, let's say they take some time before they buy the house to pay off that 42,000. That frees up 1,500 in their cash flow, for example, right? And that frees up that money is now freed up for them to at least feel a little less pressure. Okay, so focus on eliminating existing debt. Of course, their DTI ratio would also change, right? And in this case, it might allow them to be able to buy more house if they want. Okay. Not that I would advise in this particular situation. The other way to improve your DTI, which is your debt to income ratio, is of course find ways to increase your income. If in this particular case, let's say the family can move from 180,000 combined income to say 200, 250, things start to really free up in this calculation. Avoid taking on new debt just before your mortgage application. So in this case, what would be typical in this kind of situation is the family can decide they want to upgrade vehicle at that time, and then that 42,000 that is their gross debt now becomes say 73, and that changes this equation dramatically. Okay. Things like again, if you can get a higher down payment, say they get a gift, they get an inheritance, something like that, you never know, that could also help improve this equation. um for GDS, the only suggestion I would say is, as much as possible, try not to buy too much house because it will stretch your budget too thin. Again, you don't want a situation whereby 60% of your household income is going towards servicing your mortgage. 40% is pretty high, and again, I understand in this current economy and whatnot. So I'm not necessarily I don't want to be insensitive to that in any way, shape, or form. What I'm saying is you need to make sure you ask those questions and try and figure out for yourself, especially in the current interest rate market we're in. You want to make sure that, for example, if you're making 6,000 a month and you have 4,000 going towards your mortgage, that's just pressure, unnecessary pressure. I don't know about you, but my prayer point every day would be concerning my monthly expenses if I had that kind of situation. So you want to make sure as much as possible you don't want to overwhelm yourself, right, financially. And that's usually what happens because people don't understand what's happening in their finances. So what I want you to do is have a good understanding of what's happening in your finances. So you're armed with information and you can make better decisions that way. Okay. Um Calculate it for yourself. Like I mentioned, figure out what your own is. It's very easy to calculate, add everything up and do it's grade 5 math, plus, minus, divided, multiply. You understand? And then determine what you can afford before your pre-qualification. Like I mentioned, when we wanted to buy a house, we said we are not going above this amount because we calculated what the mortgage payment would be on that particular amount based on our income. That was what we were comfortable with. We did not want our house payments to be more than 25 to 35% of our take home pay. And that's because there's a whole lot of life outside of your mortgage. You understand? Children will go to soccer, they will go to dance, they will go you have to pay for daycare. They don't factor those things into your mortgage calculation. You have to buy gas in your car, you have to buy groceries to eat. You eat out, you would heck, you want to travel, you want to see the world. So there's a whole bunch of life outside of your mortgage. So basically you don't want to get boxed in, and not have options. Okay. um all right, the other thing I wanted to talk about, let me stop share my screen, is your stress test. So stress test is basically, for those who don't know what it is, it's basically you must qualify for a mortgage, for example, at 5.25%, or the contract rate plus 2%, whichever is higher. So obviously 5.25%, that was years past, at least COVID days, maybe. So basically now, for example, the last I checked, I think the mortgage rate at say BMO was like 7 point something. So they're going to qualify you at actual 9% of interest. You understand? To make sure you can actually afford the mortgage if interest rates start climbing again. So that's another factor to consider. Again, just because they say you can buy an $800,000 house does not mean you should. Because if rates were to change tomorrow, what does that look like for you and your family? Okay, so that's where the stress test comes in. I have an article actually that is actually, some people are actually pushing, excuse me, for them to stop using the stress test, just to urge competition amongst the banks and whatnot. And we might, depending on our time, we may look into those two articles. um yeah, so actually I actually want to talk about it before we go into mortgage terms. Okay. So Michael's asking if I could shed more light on the gross debt service ratio. I think I've done that. If I haven't, to your satisfaction, let me know. But I think I have. Um, how would this affect down payment and rates? How would what? How would? Sorry, I think my questions are not aligned. Oh, thank you. I think I have. Okay, let me set this up. All right. So this article I really like this week. It says here, it says Canada regulator to cap mortgages for highly indebted borrowers. Um, so basically, the gist of it is basically they're saying the OFSI. Every time I say this, their name is always sorry. I have to learn about them in different finance courses I've taken before. That's why I always end up saying the OSFI, just because. Okay, so basically, they've told lenders that they may need to limit loans to borrowers with mortgages that are greater than 4.5 times their annual income. So, in the case of what we were just talking about, the example of Jane and John, if this, limit takes effect, right, next year, like they're proposing, you won't be able to borrow for more than 4.5 times your annual income, even if you pass all the other tests, okay? Stress test, DTI, DDS, whatever. You understand? You won't be able to buy a home that's more than 4.5 times your annual income. And again, I think this is all just trying to make sure they're also use it's like they're using it for people that are, if you have less than 20%, so people that are going to be, they're going to have more debt basically than, for example, if you're putting 20% versus 5, the person with 5 has more debt than the person that puts 20% down, right? So I didn't mind the article. I thought it was pretty cool. um Banks, I think everybody is just trying to get creative in this season, right? Get creative. Obviously, the OFSI, whoa, their job is to make sure they protect financial institutions and protect the public in general, and just protect finances in general. Like, they're not trying to make sure we go into a crash, or, their job is their job. So I see what they're trying to do to a large extent. I think should one really be borrowing more than 4.5 times their annual income? You understand? That means, okay, even if you were to pay everything in the year, yeah, I don't know. I don't know. I think this one, I mean, I don't mind it. It protects the borrower too, to a large extent. The only thing is it reasonable in the current market we're in? Like, especially, for example, when you look at markets like BC and Toronto, right? And to a large extent, even Alberta is starting to catch up. Like 4.5 times your annual income. So let's say a household that makes 180,000, like I mentioned, they will be paying about this is going to limit their borrowing to about 810,000. Now, in a place like Calgary, that's a lot of option. You have quite a lot of options in houses. But in a different market, like Toronto, for example, this person may not be able to buy more than a house big enough for their family. So I think everyone has to get creative in this season, especially with interest rates. It's just a matter of time. I think, yeah, creativity is going to have to come into play. And I expect more rulings like this to come from different houses, different financial watchdogs and whatnot, just to make sure that they're protecting the public. And more than anything, they're protecting the banks, because the Canadian banks have never failed, at least that I've read so far. Um, at least they, what you call it, 2008 recession, they did really well. And I think they're just trying to make sure that even if we had something like that tomorrow, we would still be okay. Balancing the fact that housing has its issues and whatnot. It's a really good article. I would suggest reading it if you can. It's just 2 minutes. I thought it was cool, and I in my mind I was like, okay, it's nice that everybody's starting to think. The bells are like ringing. I was like, oh, okay, we need to figure something out. Um, this one I actually like. So this article is saying, a competition watchdog is saying that they should drop the mortgage stress test at renewal. Now, someone like me, I'm up for renewal very soon, so I really like this article. Because basically, so for example, If you're renewing with your current lender, you don't have to do the stress test, right? Because they've already stress tested you. So you're fine. But if you want to switch lenders, you have to go through the stress test. You understand? And some people may or may not qualify, again, based on everything we've been talking about, right? So what this article is basically talking about is they want them to remove the stress test if you're renewing, such that you can shop around for rates. You understand? So for example, let's say you're with BMO, even if CIBC is offering you a better rate, right? Because you still have to pass their stress test, it might make more sense for you to remain with BMO. You understand? And BMO, of course, knowing fully well they have that advantage, they may not put in that much effort to getting you a better rate. So that's where I kind of like what this stress watchdog is trying to do to make sure they remove it at renewal. I think it makes sense. And if it does actually pass, I think it will make a lot of sense, because that way you can actually shop around for rates when the time comes for your renewal. Okay, so there goes the articles I want to talk about. The last thing we're going to talk about, I will go to the comments real quick before we talk about mortgage terms, so you understand what they are talking about when you go into negotiating your mortgage, basically. So you understand what each term. I will do that. So stop sharing my screen, and I will. Okay, so that's 1, and this is 2. I always encourage people to read articles like this, so you know what's happening just in general in the economy slash. Oop, what did I do? Please let me know if the link worked though. Oh, I think the second one is too long. Okay. Yes, there's definitely a lot of life outside mortgage slash yes. Black tax. Sis, tell me about it. For those who don't know what black tax is, Google is your friend. That's not why we're here. Okay. I think I've answered this question. This one, it says, if a couple's first property has only the husband's name on it, and then the wife wants to buy a property in her name a few years later, how will the bank see this? Will they see it as a first time home buyer? I think the biggest thing here is the qualification, if you can qualify to be able to buy it, right? So that's what the bank is concerned about. The first time home buyer, the banks don't care if you're a first time or a second time or a third time. That's tax related. So it's the CRA that cares if you're first or second or third time. You understand? Because of some of the tax advantaged accounts. I should probably leave the question up just because it was long. Okay, so because of some of the tax advantages, it's the CRA that cares about first time home buyer. The bank doesn't care. So long as you can qualify for the mortgage, they will give it to you, whether it's you, your wife alone, or the two of you combined. So I think that's all the questions in the comments. If you have more questions, please let me know. So we're gonna go into the final thing for today. I hope you've learned something. I certainly, enjoy teaching this, but I really hope you've learned something. If nothing else, you should know how to look at your finances holistically when you're going into negotiating your mortgage. Okay, mortgage terms. So basically what to know and understand when it comes to your mortgage terms. The first thing is, of course, the interest rate. So the interest rate is the cost of borrowing. So it's basically how much it's going to cost you to get this house, right? In addition to the cost of the house. Because you're going to somebody else to give you the money to buy the house, it's going to cost you something. Like I mentioned earlier, it can be fixed or variable. So if it's fixed, it means the interest rate is going to be fixed for the interest rate, and the payment amount is fixed for the term of the loan. So if it's a 5-year term, for the 5 years, the interest rate stays the same, the payment stays the same. Excuse me. And if it's variable, it goes up and down depending on the lender's prime rate. So one of the things you also want to know and understand is the term length. So the duration of the term length is basically it's the duration of time for which your interest and mortgage conditions are locked in. Okay. Term length and amortization are two different things. Sometimes people confuse the two. Your term length is basically, okay, we've negotiated these terms and this is how long they are locked in for. So things like if it's a closed mortgage versus an open mortgage, if it's a fixed versus variable rate, um your prepayment privileges, which I find very funny when you say prepayment privileges. Okay, so those are the things that we're talking about when we say term length. So your term length can be 1 year, it can be 2 years, it can be 3 years, it can be five, it can be 18. I've seen as high as 18, at least with BMO. It can be 15, So basically they're gonna lock in for that term. That's what they're talking about. Um Again, depending on how long or short the term is, it also affects the interest rate um that you are giving access to. So if you're going to lock it in for a longer time, chances that the interest rate will be a little higher, because the bank is not going to be able to predict what can happen between now and say 18 years. Okay. Um I closed. Sorry. Okay, there we go. So amortization. The amortization is basically how long it would take to pay off the mortgage in full. So usually in Canada it's 25 years. Like I mentioned, if you're going to go to a 30-year mortgage, for example, it becomes an uninsured mortgage, based on what we talked about earlier. So it's usually 25 years for the amortization. So that's basically, if you continue paying for that long, you will pay off that loan in 25 years. Okay. That's the amortization period. You can also amortize it over a shorter period if you want. So some people, for example, they might do 15 years, some may do 10 years, some may do 20 years. It's really up to you. Um, I apologize. The 18 that I saw, it's amortization, not term. Forgive me. Usually the most common is 5 years in Canada. Um, Prepayment privileges. So what you need to know here is basically the allowance you have to pay off a portion of the principal or make lump sum payments without penalty, right? So usually if you prepay a mortgage or if you repay a mortgage in full, there's a penalty, especially if you pay it before, the term is over. However, in most mortgages, there's a prepayment privilege. So I mentioned an example earlier. Oh, some mortgages may have, you can pay up to 10% of the principal without penalty. Anything over and above that, there will be penalty. Okay. So you also want to look, when you're looking at your mortgage documents, you want to know what those prepayment privileges are and negotiate it. Okay. You can negotiate it. Just because they say 10, depending on the type of mortgage, you could ask for 20. I won't go into those details, but again, for all the terms, again, it's a term. You're negotiating a contract. You can negotiate on every single thing I've talked about so far. Okay, including the interest rate. So make sure, don't just take what they give you at first glance. Talk, ask questions, ask for better, shop around. Okay. Um, Penalty for early repayments is usually at the lender's judgment, and they usually consider current interest rates. There are various online calculators where you can use to calculate. So, for example, let's say you're going to pay off your mortgage early for whatever reason. You have a crypto that blows, you win the lotto. There are different reasons why you can repay your mortgage early. So it's usually at the lender's judgment, but it's also written into the terms. So you want to make sure you read that section to understand what is going to happen if you are able to repay it early. You also want to read up on areas such as portability. It allows you to transfer your existing mortgage to a new property when you move without incurring penalties. So, for example, you live in a starter home, you want to upgrade to a new house. Are you able to move that mortgage? You understand? Or something like that. So, don't make sure you read that section and understand what's happening there. Assumability. So, for example, would your mortgage allow somebody else to assume your mortgage? So basically, it allows a new buyer to take over your existing mortgage, and this can come in very handy in periods whereby, say you're facing a financial crunch. I remember when there was a bit of a downturn in Calgary. So a lot of people were losing jobs. The oil and gas was not selling and all that. So a lot of people gave up their mortgages, and those that had assumable mortgages were very lucky, because all they could do was just get somebody else to buy their house, and they just transfer the mortgage to the person and they walk away, without necessarily losing anything. So you want to make sure you understand stuff like that in terms of what is in your mortgage, just so don't just yeah, don't just you know don't sorry, I just saw Oge's comments and it made me laugh. Many of us have prayed to win the lottery. Yes, so yes. You have to play it first to win it. That's the thing. I always joke about it and I never play. So I see a question here. So in this case, not necessarily. If you're buying a second property, it depends. Is it going to be your primary residence? Like, is it going to be where you're? So, for example, let's say you are in a starter home right now, and then 3 bedroom, standard up and down, you know, second floor, blah 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 type house, and now you want to move into a second property because your family has increased. You want to buy a 5 bedroom house now, right? Once you're buying the second property, they don't necessarily need a higher down payment. You can also put 5% down because that house is now going to be it's going to be owner occupied. So long as it's an owner occupied property, again, there are other factors to consider. It would. Oh, so you're saying it won't be your primary residence. If it's not your primary residence, then yes, the usual is you need 20% down payment. Even if it's you or your wife, that's buying it. Unless I'm missing the question. I think it's in 3 different areas. So I may need to look at it combined. But if it's not going to be your primary residence, then if it's not going to be owner occupied, then you usually would need 20% or more for down payment. So, for example, let's say you guys bought your starter home in your name, right? And then you want to buy a rental property in your wife's name. Provided you guys are not going to live in it, then it's non-owner occupied, and those rules are what you're going to have to operate under. Okay. Um, if there are no other questions, wow, we took almost an hour. That's awesome. So I think we're going to wrap it up here. Okay, there's one more question. Says husband already bought the first house that they both live in. Wife now wants to buy in her name and qualifies easily. Yes, there's absolutely nothing wrong with that. The point is, if the wife is not going to live in that house, it's not going to be owner occupied. So therefore, the rules that apply will now be non-owner occupied rules. You understand? I know, let's keep going. Please, like I said, there's a whole lot of life outside YouTube. And there's a whole lot of life outside mortgage payments. So yes, so the biggest thing here that the bank is worried about or the bank cares about is it going to be owner occupied? So that's another, we talked about that earlier. So in this case, if you bought the house and now your wife wants to buy another house in her name, if you're going to be renting it out, those are the things you're going to have to show. Again, I said what I said. Okay. I think we'll wrap it up there. I'll give it one more minute for any other questions, but thank you all so much for joining today. I hope you learned something. If you did, please put it in the comments, let me know. If you did not, go back, watch the video again from the beginning. I'm sure you would pick something up that you missed. And yeah, thank you for joining us. We will see you again next week. Next week's topic. I'm still marinating. I've gotten requests, to talk about debts and debt management. I'm still considering which one I want to do or how I want to approach it. Because again, debt is one of those things. It's massive, right? For example, today we talked about mortgages. It's a type of debt. Still, I will put out a banner next week and then we'll go from there. Question says there's a question here. It says, "Thank you so much, Oge. I appreciate the feedback." So there's a question from Michael. Says, what if the second house is just for family, not for rent? So then it's owner occupied. So that means you guys are going to be living inside the house, right? Or when you say family, you're talking about extended family. Even if it's extended family, it doesn't matter because you are not living in it. So it's still non-owner occupied. Literally, you and your family have to move inside the house for it to be considered owner occupied, right? Again, just based on if it's for extended family, it doesn't matter. It's non-owner occupied. Yeah, so it was still, again, unless you guys are not necessarily again, depending on the structure of your family. So I wouldn't, unless I have a full understanding of the structure of that family. But for the most part, if it's non-owner occupied versus owner occupied, that's usually what they're considering. So I could buy a house for my parents today, right? That I would still need to put 20% down because I'm not living in the house, So that's kind of where we go from there. Okay. In that case though, you could potentially gift your family the money for the down payments, but then the house you will buy it's like, almost like a joint. Anyways, I won't go into all that today, but I'm glad I've been able to clarify. Okay. We will wrap it up here. Thank you all so much for joining us. Really appreciate your time. See you all next week.